Okay, everyone, welcome to class, first of all. And on that list of items for learning modules for week one, what I want you to take out is the financial statement. I think it's called financial statement and ratios, but it's called reading and understanding financial statements. And you might want to look at that while we're going through this. What I want to point out, first of all, you'll see various items throughout the report. You want to, of course, read it all. But I just want to go over some account names with you. So the first actual financial statement we see is on page 6. It is a balance sheet. And let's go through that. It shows balance sheet for December 31st, 2009 and 2008. And first of all, under assets, your assets must always equal your liabilities plus your shareholders' equity. So that must always be in balance after each and every transaction. Your current assets are those items that are either cash or will be turned into cash within the next accounting period, which for the most part is a 12-month period. So cash and cash equivalents, that's obvious what that is. Investment and trading securities, again, that spells out what it is. But where it shows accounts receivable less allowance for doubtful accounts. Doubtful accounts, that's something that you decide every year. There's a formula where you're going to determine which accounts you do not think will be collected. Those are doubtful accounts. We're not going to really go into that at all in this class, but accounts receivable is important. What an account receivable is, for example, if I'm Lord & Taylor and you come in and you buy a shirt and you charge that on your Lord & Taylor account, it's an account receivable to me. I consider that the sale's been taken place and the actual transactions occurred, but I didn't get the money yet. What I have is an account receivable. What happens with accounting is it's based on accrual for the most part, for most organizations, rather than cash. So what accrual accounting says is basically at the time a sale is actually occurs, whether or not the cash is passed hands, it's considered a sale. And that's why we have an account receivable at that point. Inventories, that's what we are selling. So if I sold these erasers, when I buy these erasers, let's say I bought 10, I hang on to them on my balance sheet. I consider that an asset. I hang on to that until I actually sell the item. Once I sell the item, it's released on the income statement as an expense in my cost of goods sold or cost of sales section. But initially when I buy it, before I sell it, it is considered an asset. And the reason for that is in accounting you want to match your revenues with your expenses. Since I haven't generated a revenue yet, because I haven't sold that eraser, I'm not going to consider any of the expenses incurred in the actual purchase of that eraser. Or if I made them, the actual manufacturing of the eraser. Prepaid expenses, those are expenses that haven't been incurred yet, but I paid for them ahead of time. For example, prepaid insurance. If I pay for a whole year of insurance on January 1st, I haven't used it yet. So I'm going to hold on to it in my current assets section as prepaid insurance or prepaid assets until the point I actually incur the expense. At that point, I would transfer it from the balance sheet to the income statement as an expense, insurance expense, or it might be considered selling, general and administrative expenses, depending how the company allocates their expenses. But initially, if I haven't incurred the expense yet, it is considered an asset. Okay, you'll notice then they total all the current assets, and then under property and equipment, you're going to have your long-term assets. Those are assets that will not be turned into cash within the next accounting period. So we have land. Land, of course, we all know what land is. Land is not a depreciable asset, just so you know that. Buildings and improvements, we all know what buildings are. Machinery and equipment, again, we all know what that is. And then we have something here called accumulated depreciation, which I'm going to talk about, I'll talk about a little later. But what that is, again, when we buy these assets, let's say we buy something and it's going to last for 10 years. We are not going to expense it out on the income statement all at once. We're going to expense it out period by period by period. So then you'll see there's a total assets where it's, of course, adding up all the assets. The next section is our liabilities and stockholders' equity. Under current liabilities, we have a notes payable. That actually is very similar to an account payable, but it's more legal in nature. But let's say a notes payable might be I loan another company $1,000 for a month. That would be a note payable. If a note is short term, if it is expected to be collected within the next 12 months, it is considered a current liability. I then have current maturities of long-term debt. What that is, maybe I have a mortgage, for example, that's 30 years. But during this accounting period, during the next 12 months, I'm going to pay $5,000 of my mortgage off. I'm going to consider that a current maturity of the long-term debt. Next, we have accounts payable. What that is let's say I go to maybe Office Max and I buy a pen that I'm going to use in the daily basis of my business. It's just a supply. And I don't pay for it. I charge it on an Office Max account. That's an account payable to me. Transactions incurred, I have the item, but I haven't paid for it yet. And again, if I'm going to pay for it in the next 12 months, it's a current liability. Income tax payable, we all know what that is. And then they have various accrued expenses, and you'll see they add up total current liabilities. Other liabilities, they have long-term debt, net of current maturity. So that's the long-term debt we're not paying off within the next 12 months. And then they have deferred income tax. They add it together, and that's their total other liabilities, and they add the current and the long-term together for total liabilities. Stockholders' equity, last section. You'll see they have 9.5% cumulative preferred stock at a par value of $10 and common stock at a par value of $1. So you'll see that total. What common stock is something you've sold. You're a public company, for example, let's say you're public, and I'm selling stock on the market, on the New York Stock Exchange. What a par value is just an arbitrary figure. Certain states require it, other states it is not required to have any par value, but a company still might have something called a stated value. But what that is an arbitrary value I assign to my stock. It is not what it sells for. So you will see an account below that called additional paid-in capital. So let me explain the difference between the two. So let's say I have stock. I'm going to these are all the ratios. I already put them up, but I'll just put this in the corner. Let's say I sell stock, one share, and my par value is $1. I would have common stock here for $1. But let's say it sells on the open market for $10. That's going to be my additional paid-in capital. So I would have additional paid-in capital. It's selling for for 10, and my par is 1. Additional paid-in capital for that share of stock is 9. So that's all it means. It's what the actual par value is. That's my common stock. My additional paid-in capital is the difference between the par value and what it's sold for. Next is retained earnings. What retained earnings are is that portion of net income that we did not pay out in dividends. We kept it within our company. And then you'll see less cost of common stock held in treasury. Treasury stock is just you went out in the open market and you bought back your own stock. That's treasury stock. Okay, so that's just some various items on the balance sheet. Let's talk about the income statement, which is on page 8. And actually, when you prepare your financial statements, your income statement is prepared first. That's the first item you prepare. But let me go over the various accounts. You have sales. We all know what that is. Let's say I sell this eraser. That's my sales. And if it was somebody bought it for $5 and I sold one eraser, my sales is $5. Cost of goods sold. That is the point that you have transferred from the balance sheet. Remember with that inventory? That's what we bought it for. When we sell it, we transfer it from the balance sheet to the income statement. So for example, if this was showing on my balance sheet for $1, this eraser, because that's what it costs me, my cost of goods sold, my inventory would now be 0 because I'm transferring it, and my cost of goods sold would be $1 because I'm selling this eraser. Okay, when you subtract your cost of goods sold from your sales, that gives you gross profit. Selling, general, and administrative expenses are your everyday expenses incurred in the operating of your business. We're going to subtract that from gross profit to end up with income from operations. In this case, they have some other income and expenses, and they're kind of grouping them out, but they have interest expense. You know, maybe if we borrowed somebody money on a note, they're paying us interest. Or excuse me, we borrowed money on a note from somebody. Let's say we have a note, we're paying interest, that's interest expense. Dividend income, maybe we have stock in another company, and we've gotten dividend income for that. Interest income, that's what I was talking about previously. Interest income is, you know, maybe we borrowed somebody money on a note and they've had to pay us interest for that. That's income to us. And then they have some other items net on there, and they have a total. Again, we're going to go ahead and we're going to subtract that from income from operations to arrive at our income before income tax and extraordinary items. Income taxes, that's obvious what that is. We're subtracting that. That gives us income before extraordinary items. In our case, we have an extraordinary item, which is less applicable income tax benefit of $32,000, and that's being subtracted. And then we finally arrive at net income. What an extraordinary item is, just so you know, maybe you had a major fire, something like that, and you sustained a huge loss, and maybe you got no insurance or whatever portion wasn't insured. That's an extraordinary item. It's not the everyday happening of your business. So again, then we arrive at net income. Okay, so that's our net income. If you look, it shows retained earnings beginning of the year. It shows dividends paid and then retained earnings at the end of the year. What you do is you take your net income, you add, and it's not really done in this, it's usually your beginning of year retained earnings plus net income, but it doesn't matter. For our purposes, it makes no difference. But you're going to add your retained earnings at the beginning of the year and your net income. You subtract the dividends you paid out, and that gives you your retained earnings at the end of the year. So that's basically how you've taken your net income from your income statement, and you're able to transfer the net income amount minus any dividends you paid into your balance sheet. So that's basically the connection between the income statement and the balance sheet. That's how the one goes through to the other. There's another statement, which we're not going to go through, but there is, if you're interested yourself, there is a, on page 10, statement of cash flows, and you're free to go through it yourself. But we pretty much went through all the items, the actual what they're called, so I think you'll be fine with that. So now I want to turn to the assignment. You have a practice, which shows as practice exercise high flyer and practice solution high flyer. I want you to look at both of those. You might want to make a printout as we're going through these ratios. And let me tell you first, ratios in and of themselves are pretty meaningless. You need something to compare them to. And they're only one item in a lot of different items that are important. They're just one item we're going to look at to determine information about a company. But what you can do with ratios, you can do a trend analysis where you compare the company to itself over several years, or an industry analysis. You can compare what's going on in the company to the rest of the industry and see if they're doing better or worse than the rest of the industry. So let's go through how we calculate this. And for your assignment, you don't have to do this. Your assignment is assignment number 1. It shows up out there. All you're going to have to do in your assignment is literally take your figures and transfer them from the PDF file you have. Those figures, you're going to transfer them onto the template, the Small Biz template, and all the calculation is going to be done for you. But I thought it'd be good to see how it works just so that you're aware of what you're doing. And you might want to try some of the practices too. But first we're going to start with ROE. Return. Oh, before we do that, let me go through. If you look at your solution, and you look at the bottom of the solution, it shows calculated totals, and they have current assets, current liabilities, total liabilities, and liabilities plus equity. It's always a good idea to kind of total it ahead of time, and it makes the calculations easier. They're much faster. For example, the way they came up with current assets for the current year, you look at your current assets. So in our case, it's our cash, accounts receivable, inventories, and prepaid insurance added together. When you're looking at total assets, it would be the total current asset amount plus your long-term assets. Okay, and you're doing that each year. Looking at your current liabilities consists of your accounts payable, your notes payable that are due in 10 months, and your wages payable. Those are all considered current liabilities. Quick way to do your total liabilities is just take your total current liability figure and add to it your long-term liabilities. That'll give you total liabilities. And to determine your liabilities plus equity, you can take your total liability figure and just add on the equity figure, which is your stockholder or owner's equity. So if you look, you'll see, you can add them yourself, you'll see that the totals come out right for the current year and for the previous year. So let's talk about ROE real quick, and that's our first item, return on equity. And it shows you, if you look at the solution, it is your net income divided by your average equity. Whenever you see the word average, the way that's determined is they take the current year plus the last year. In our case, it's periods in other cases, but it's the current year plus the last year. You add those two figures together, you divide by 2. That's how you get the average. So if you look for ROE, net income, if you look on the sheet, you see net income's $20,000. Our equity is $196,000 for the current year, $176,000 for the last year, so we divide that by 2, and we end up with $20,000 divided by $186,000, and that tells us our ROE is 10.8%. What ROE is, I'm going to just talk about this for a minute. ROE is our profit margin plus our asset turnover plus financial leverage, all calculated together. This is the most important item. This is what everybody's looking at to determine how you're doing. You can compare it to yourself. You can compare it to the industry. But what this shows is profit margin shows us what's happening on our income statement. Asset turnover and financial leverage show us what's happening on our balance sheet, what's happening on our asset section of the balance sheet, and what's happening on the liability and owner's equity section. So that's why this is such a critical ratio. But if you're doing really well compared to the rest of your industry, everybody's going to emulate what you're doing, and they will all probably have higher ROEs, so you won't be higher for longer. But this is really important, and if you don't have a high enough ROE, you can work backward through these various ratios to find out what your problem is. The other item I want to mention is profit margin and asset turnover are inversely related. The higher your profit margin, the lower your asset turnover, and vice versa. And the reason is this, it's different industries basically have different profit margins and asset turnover. So let me give you an example. If you are at Dominick's and you're selling your grocery items, those are going to sell very quickly. You're going to have very low profit margin, but a huge asset turnover. If you are a high-end jeweler selling $1 million diamond, you're going to have very little asset turnover, but very high profit margin. So they're going to always work inversely. Okay. The next item is ROA, which is return on assets. And again, net income, if you look at on the sheet, you'll see, and we're always looking at the current year. The only reason we look at the last year is if we're doing an average. Other than that, we're always looking at the current year. So here we're going to take our net income divided by our average assets. So we're looking at our assets for this year plus our assets for last year and dividing that by 2. We end up with 6.7%. Net working capital. That's just our current assets minus our current liabilities. So how much more do we have in current assets than we have in current liabilities? Okay, that's all that's telling us. Current ratio is our current assets divided by current liabilities. So what this tells us is we have 2.7 more in current assets than we do in liabilities. And again, is that good or bad? It really depends on the industry, and it depends on where you are as a company. You might have too much in current assets. That would be a problem. So this is all going to be dependent on where your industry is and where you as a company are. If you have too much in current assets, then what might be occurring is that you're really not utilizing your assets well enough. Okay. Your liability to equity, again, we're taking our total liability figure and dividing it by our total equity figure. and it is 0.56 to 1, which means we have about 56 cents in our total liabilities for every $1 of equity we have. Average collection period is our average accounts receivable, so it's our accounts receivable for this year and last year, and then divided by 2, and we divide that by our sales, divided by 365. That's considered how many days there are in the year. So when we go through that calculation, it's 36.5 days. That tells us that on average, it takes us about 36 and a half days to collect our accounts receivable. And, you know, that sounds pretty good to me, but it depends on the company, it depends on the industry, it depends what your goals are. Next one is receivable turnovers. What that's telling us is how many times during the year do we collect, on average, our receivables. That's just our sales divided by our average accounts receivable, which we already figured out here, so we can just pull that number over. But that means we collect them about 10 times during the year, which would be consistent with 36 and a half days. Next one is number of days sales and inventory. That's our average inventory, so our inventory from this year plus last year divided by 2. And we're going to divide that figure by our cost of sales divided by 365. So that's about 119.9 days. That's how long, basically, it takes us to sell our inventory. Now, that might be something that this company needs to work on, but again, it depends on the industry, and it depends on the company as to whether or not that figure does need to be worked on. Last thing is how many times during the year, inventory turnover, how many times during the year are we basically selling our inventory? That's going to be our cost of sales, which we've already figured out, $175,000 divided by our average inventory, which we figured out here, $57,500. So basically, 3 times during the year we sell inventory. Again, at first glance, it looks like it's something that should be worked on, but again, it's peculiar to the company and to the industry, if that's good or bad. Maybe they've been getting better over the time, so that might be a good thing. The next thing that I want to tell you about real quickly is that when you're not going to calculate any of this yourself. None of this has to be calculated. And I apologize, my phone is ringing, so just ignore my phone. But you're not going to have to calculate any of this on your own. When you're doing the assignment, you're going to simply take it from the PDF file, those figures, and just put them into the template, and it's going to calculate all these ratios for you. Okay? So you're more interested in knowing what's going on behind those ratios. Okay, the next thing that I want to talk about real quick is depreciation. I'm just going to go over that really fast. Let's say there's 3 things you need to know to calculate depreciation. And let's assume we're just going to do straight line depreciation. You need to know the cost of the item. You need to know how many years you're going to use, or how many periods or years you're going to utilize it for, so the time. You need to know the salvage value. So let's say I buy a desk, and the cost of that desk is $10,000, and I'm going to use it for 4 years, and my salvage value is $2,000. And what that means is at the end of the period, somebody's going to buy it, for example, for $2,000. That's how much it's worth at the end. The way I would do this, and again, this is straight line, I'm going to take my cost, subtract my salvage, and divide it by the number of years. So that would end up being 8,000 divided by 4. Each year, I would depreciate $2,000. So that means every year on my income statement, I'm going to depreciate $2,000. On my balance sheet, every year I'm going to add $2,000 to accumulated depreciation. So if I, for example, bought this on January 1st, on my balance sheet, at the end of December of, say, 2013, I'd have accumulated depreciation of $2,000. I'm going to keep a running total of this. So at the end of 2014, my accumulated depreciation would be $4,000. So every year it would be increasing by $2,000. This is called a contra asset account. It reduces my asset accounts. So although I would call this equipment perhaps on my balance sheet, I'd have total equipment. It cost me $10,000. But if you look, what's the book value of that equipment at the end of year 2? $6,000. It's the equipment minus my accumulated depreciation. Okay? So again, every year, balance sheet or permanent accounts, it's going to always stay there. On my income statement, I have temporary accounts. We close those out at the end of the year and start over again. Balance sheets are permanent. It's a picture, a snapshot at one point in time. Income statements are going to close out at the end of the period. They're for a period of time. So on my income statement each year, 2013, 14, 15, every year I have this equipment, this desk, my depreciation expense is going to just show 2,000. Okay, it's not a running total. It just shows the actual amount of expense I incurred for that year. So hopefully this gives you kind of a picture of what's going on. If you have any questions, feel free to call me. Again, this is due, this assignment is due this week. If you do have a question, if you're confused, feel free to call me at any time, or if you want to send it to me at least a day before it's due, you can do that and I can go over it and tell you if you need to change anything. But hopefully this gave you enough information that you're able to complete the assignment and understand a little bit about what's going on. We're going to just get a cursory overview probably in a lot of this because it is only 5 weeks and we're covering a lot of things. But hopefully at least you have some idea of general accounting. So I will see you again next week.